Most traders draw random lines everywhere, and they don't know where to find high probability key levels. In this video, I'm going to show you how to find and draw the most important key levels that's going to help you improve your trading massively. The levels we're going to focus on is how to identify and draw fair value gaps, how to identify and draw weekly and daily highs and lows, and opposing levels. These are the three I use most often. Fair value gaps is really about finding a 3-candle combination, and the candle in the middle is going to have a gap or a space which we call an imbalance. This usually occurs where we have displacement to the upside or displacement to the downside. Massive selling orders or buying orders that moves price rapidly creates these spaces between the candles, and these are high probability liquidity zones where price is likely to return to tap into that liquidity. When identifying fair value gaps, I like to use the higher time frames, either a weekly chart, a 3-day, a daily, a 4-hour. The higher the time frame, the stronger the level. So as you can see, I'm on a weekly chart right now, and you can see we can mark out the fair value gaps. We get this massive displacement to the upside, price returns to the fair value gap, and this is where we want to pay attention for our entry criteria. When price simply arrives at our fair value gap, we don't enter. We wait for entry confirmation. And then you can see over here we get a massive impulse move to the upside. This displacement to the upside leaves behind a fair value gap over here. Price breaks through that fair value gap and then leaves another one. So we never really know which fair value gap price is going to respond to. All we do is when price comes to that level, we want to look for our entry criteria specifically at that level. You can see price responds very nicely off that level and then creates another impulse move. And we get another fair value gap created. We mark out that fair value gap. Price never got to that fair value gap, but then I saw another one over here. Price tapped specifically into this fair value gap and we got a nice reaction off of it. So once you're able to mark out your fair value gaps, all you want to do is wait for price to come to those fair value gap. Once it comes to the fair value gap, we want to look for your entry criteria. If you want to understand more about entry criteria, make sure to watch my previous videos. I go into tons of detail, or click the link below. I have an indicator that's going to help you massively with this. We currently have a free trial to test it out now. Here is another chart, and I just want to show you the precision of how fair value gaps work. You can see over here, this is our fair value gap in this region. We mark it out. I consider it a valid fair value gap until price closes with the candle closure over their fair value gap. You can see on the weekly chart, we got this candle wick coming through, but we did not get a candle closure. And you can see prices responded at this region as well as at this region. It is very evident that price is respecting this area. Every time price comes back to the fair value gap, it responds to it. So these are the places you would want to jump onto a lower time frame. I've zoomed into a 1 hour now. Price is tapping into that level. Let's just show you clearly when price taps exactly into that fair value gap. Price loves to react and respond at liquidity levels. The next key level you want to pay attention to is previous day highs and lows and previous week highs and lows. So all you have to do is go into a daily time frame, mark out the previous day high and low, or a weekly time frame and mark out the previous week high and low. These become liquidity areas when price comes to these levels. That is where you want to go into a lower time frame and focus on your entry criteria. Here I am on the weekly chart, and as you can see, I'm going to mark out these weekly highs and lows. There's a weekly high, and here is a weekly low. And you can see as price gets to the high, it responds to it. As it gets to the low, it responds to it. So I take the next week's low, mark it out, price reacts and responds to it. We get a reversal off that low. Also, if we want to mark out this weekly high, and then we extend the price all the way across, you can see how price is respecting it even further into the future. If I mark out this weekly low, you can see price is reacting and responding to it right over there. It's getting a reversal. If I mark out this weekly low, you can see price is reacting and responding to it. Also, if I mark out this weekly high, it's basically in a very similar region. If If I mark out this high, price did not react at this level, it simply broke through. So what you're going to do is if price breaks through a weekly high or a daily high, there's a high probability it'll go to the next level. If we find rejection at that level, there's a high probability it's going to reverse. So once we've marked out these key levels, then all you want to do is wait for price to get to the key level, go to the lower time frame, and then look for your entry criteria strategy. Whatever your strategy is for entries, if you don't have one, make sure to check out my previous videos. I go into a ton of detail. So here we are on the daily time frame now, and you can see if I mark out this daily high and low, you can see as price breaks that daily high, what do we get? We get a huge drop to the downside. If I mark out this previous high, we get another drop to the downside. If I mark out this previous high, we get a drop to the downside as well. You can see over here, if I mark out this previous low, we get a response. If I mark out this previous low, we get a reaction to the upside. And here we get a response. It's not always going to work, but that's why use our entry criteria after we see price reaching these liquidity levels. You can see at this low here, price kind of broke below, and then it was able to break above and take off to the upside. So it didn't respect those lows. If we mark out these lows, you can see as price got to this level, kind of went below, and then it got back into the range and then took off. If we mark out this high, price tapped into that high, and then we got a response from that level. So daily and weekly highs and lows, it can also be used in a very similar fashion as swing highs and swing low points as well. Finally, if we mark out this low, you can see price got to those lows and found resistance at that point, was able to come back into the range, and then we got this massive move to the upside, precisely to these swing high points over here. Once it tapped into these swing high points, all you're going to do then, guys, you're going to go into a lower time frame when price taps into a key level, and look at that. And then you're just going to wait for your entry criteria, which is going to usually be an opposing level break. Wait for price to break an opposing level. Once it breaks that opposing level, then you've got your entry sorted out. And the final key level, which I absolutely love to use, is the opposing levels. All you want to do is you want to mark out swing high and swing low points. And when accompanied with these impulse movements, they become very valid levels. So let us go into the chart and I'll show you exactly how to mark these out. Opposing levels are very similar to CISD levels. The only difference with the CISD level is we have to wait for a sweep. Can you see we get a sweep occurring over here? Get the sweep occurring, and then the candle or series of candles that causes the sweep is the CISD, or also an opposing level. So basically they're the same concept. The only difference is the CISD occurs in combination with the sweep, but the opposing levels you can mark out regardless of if there's a sweep or not. So in this instance, once price broke above this CISD or opposing level, this was going to be our place where we would look for an entry. We would obviously go into a lower time frame to get a more precise entry. These also are opposing levels. If you come to the top, if I mark out these tops of these candles, and you can see when price comes in here, it has major resistance within these zones. So you can absolutely see how it respects these levels. On another chart, you can see these would be the opposing levels. I'd mark out these lows over here, and I would also mark out this high over here. Since I'm marking out these levels on the daily chart, these become my daily opposing levels. Then I can always come to the 4-hour time frame, and I can mark out 4-hour opposing levels as well. You can see at the top here, we've got this sweep occurring. Price is sweeping this high and then coming down. So what I would do is I would mark out, this would be my 4-hour opposing level that I would mark out over here. You can also see we get another sweep occurring right over here. And we always want to focus on the candle or series of candles before the sweep occurred, which was right over here. So this would become another opposing level. Once you've got your opposing levels marked out, we simply can go to a lower time frame, a 1-hour time frame, or a 15-minute time frame to look for more precise entries. Once you've marked out your opposing levels, just notice how price is respecting these levels. You can see over here price broke below these opposing levels with this massive displacement. It also left behind a fair value gap. We mark out that fair value gap, and you can see price retraces into this fair value gap. So oftentimes things won't be picture perfect, like price might not come exactly into the fair value gap, it might just touch the fair value gap and respond from there. And then you notice after it taps into here, we get another opposing level. It breaks this level. And just look how precise it is, guys. If I come and mark out a 1-hour opposing level now for more Specificity, I mark out this level. Just notice exactly the precision of this. Price breaks down, finds rejection at this opposing level, and also pay attention if we get another fair value gap. Price is tapping into the fair value gap and the opposing level at the exact same time. So when you get a confluence of multiple levels at the same time overlapping, that is a higher probability entry. So this would have been a fantastic place to look for an entry. Price breaks down, comes down to this daily opposing level, breaks out of the level, then it comes back into the level. Now notice this, just notice the precision here. As it breaks back into the level, notice it leaves behind a fair value gap. So it taps into this fair value gap and taps exactly into the opposing level. Guys, you cannot make this up. Look at the precision of it tapping exactly into that opposing level. Once you can learn and mark out these opposing levels, fair value gaps, daily highs and lows, you're going to be so surprised at how price respects and responds to these levels. The key to your success as a trader is learning to identify the liquidity in the market. And since price always moves from liquidity to liquidity, this becomes one of the most important aspects for you to become proficient in. If you want to learn more about key levels and entry confirmation when price arrives at a key level, make sure to click this next video now. I'm going to go into more detail and I'm going to show you exactly how the strategy works.